Great to see a lot of familiar faces. Hi, John. Good to see you. There's Kai. Good. Oh, Haley is joining as well. Hello, Haley.
Good morning.
And we have Hannah. Good to see you. Or have you, I should say. All right, gentlemen, are we ready to go?
We are ready.
All right. Well, perfect. Welcome. I'm Yvonne Schwab, ACG Silicon Valley CEO. As many of you already know, ACGSV is the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. ACGSV offers an array of networking opportunities. With almost 13,000 members in 59 chapters across the world, ACG provides local connections with a global reach. ACG Silicon Valley is offering a variety of virtual events in the coming months. We invite you to visit our brand new website, acgsv.org, to see the full calendar of upcoming events, including our M&A circles, How Software and Technology M&A Survive. In February, RSM is sponsoring an event on how 2020 changed e-commerce strategy forever. We are also really excited to have an event in collaboration with Santa Clara University on gender and racial bias in venture capital. And we also have our round robin networking events with the San Francisco chapter, and something different this time, a Zoom makeover, up-level your online screen presence. So come and join us for that. One housekeeping item for today, please keep yourself muted until called upon. Thank you for that. And now we're excited to offer you today's event, which would not have been possible without our sponsor, Riemann Law, a high-end boutique law firm with the multidisciplinary global reach of an international firm. So thank you. Now, without further ado, I will hand over to our moderator today, Jim Chapman, a partner at Riemann Law. He focuses his practice on securities law, venture capital, mergers and acquisitions, and international business transactions. Jim?
Thank you very much, Yvonne, and welcome all to our economic outlook for 2021. I think this is the 8th year that we've done this program. We always do it in January, and I don't think this could be more timely of a program for this year, considering the election and all the things that happened in 2020 and how we look for 2021. In a moment, I'll turn it over to each of the panelists to introduce themselves. We've got the same panel that we had last year, which always, that kind of institutional memory is really helpful as we look forward. One other announcement, I've chaired the C Circle since it began about 8 years ago, and this is my last event that I will be moderating and chairing, and I'm turning this over to Kai Westerwell, an attorney with Bird & Bird. So be on the lookout for future announcements about ACGSV C Circle programs. So let's have the panelists quickly introduce themselves. Chris, why don't you start?
Okay, great. Thank you, Jim. Good morning, everybody. Of course, my name is Chris, and I am the Chief Investment Officer of Silicon Valley Capital Partners. Been in that position for 24 years now. And we invest money for individuals here in the Silicon Valley, as well as throughout the United States. And we focus on the capital markets and the stock, bond, equity markets, very liquid assets.
Eric?
Thank you. My name is Eric Goodbar, and I work with the BNY Mellon Investor Solutions Group. I'm located here in the Bay Area, although I travel all around the country and around the world at times. And my role is to work with our largest family offices, institutional investors. And my background is about 10 years on a trading desk in Chicago, another kind of 10 years working for a commodity trading advisor, and then also heading up the investments for 2 different family offices. And then I've been with our bank now for about 16 years, about 10 of that on the institutional side, talking to the likes of, CalPERS and CalSTRS and, investors around the world. So I'm an armchair economist. I sit on various investment committees within our group. And particularly, I find my time best spent talking about private equity investments. I sit on our private equity committee. So I'll stop there.
And last but not least, Brett.
Brett Ryan, good to see everybody again. It's certainly a different field than this time last year. But economist at Deutsche Bank, we set the forecast for the firm for GDP, inflation, and certainly the Federal Reserve outlook is key to our key responsibility. Been on a trading desk, specifically the bond trading desk, for a little over 10 years now. And yes, we speak to all parts of the bank, equities, fixed income, corporate banking clients. We set the house view, so to speak, when it comes to interest rates, GDP, and employment.
Fantastic. And just one other note to all our attendees, we've got the chat box, which I'll be monitoring throughout the program. So make liberal use of it for questions, comments, suggestions, and other. But let's dive right into it. So what I want to do is I want to get a baseline. So I want to ask each of our panelists, and we'll start with you, Chris. From your viewpoint, what's the status of the U.S. economy today?
That's a very complicated question for me. So part of what I do at our firm is I develop macroeconomic strategies, and I run our risk model building team. And so we look at this in various different ways. So we're defining this as a phase one liquidity cycle for the U.S. economy. And that basically means that we're below trend economic activity, and we're at very low interest rates, and a very strong monetary policy implementation. And so think of it like we're back to 2001 and 2, or we're back to 2008 or 9 in terms of where the business cycle is relative to the Fed policy. Of course, this time is very different than those two scenarios, because this time we're not in a financial crisis, first, and secondly, there's a very big part of our economy that is hitting record levels of earnings. And so it's very different. And I think the recovery this time around will be very different than these prior recoveries. Okay. When we really see here in the US, the digital economy has accelerated. Everyone knows that, especially Silicon Valley executives. You see the digitization investment all-time highs. You see the big tech companies breaking records in earnings and valuations. Meanwhile, Main Street, smaller companies that don't have a digital strategy are really hit hard. And so, at the macro level, 2020 wasn't bad for the capital markets, right? And if you invested, you're mostly in the US and stuck with companies that had a digital strategy. They were able to control their balance sheet in terms of labor, weren't relying upon human efforts for their productions. These industries did extremely well. But if you were a smaller company, did not have a digital distribution channel, and you were closed down to protect the population against the virus, you had a very, very difficult year. Okay, so I think that continues. So that's my answer, Jim, for 2020. I think the vaccine rollout is going to be slower than expected here in the US.
Well, hold that thought for a moment. Hold that thought for a
Okay.
moment. Brett, let me let you jump in here and give your
Sure.
view on what the status of the U.S. economy is at the moment.
Yeah, so I think, just to back up and start from where, ourselves and most others were just 6-7 months ago, where we were expecting 2020 growth to end the year at, -5%, -6%. And now we're looking to end the year at -2.3%, which is absolutely remarkable considering where the historic depth to which the economy fell apart in the second quarter. And so I think it speaks to the massive and unprecedented amount of monetary and fiscal policy acting together in unison, which is what separates this event from any other previous recession and is set up for a recovery that is also going to be unlike any other previous recession that we've seen. With the latest fiscal developments, Democratic sweep in the Georgia elections, opening the door for another fiscal package, we've built in an additional $900 billion in stimulus coming with the next legislation. That takes us to 6.3% on Q4 over Q4 real GDP growth. We were previously at 4.3% after the last package that was recently passed in December. So on our metrics, that takes the unemployment rate to at or below 4.5%, which is just unbelievable when you think about where we were back in April. Now, that said, the unemployment rate is definitely being understated at the moment. And I would say that while the headline says 6.8%, when you look at the misclassification and you look at the underemployed, this is more like double digits. So we want to be a little bit cautious about stating that everything is back to normal. Obviously, it's not. There are still, 18 million people collecting some form of unemployment insurance between pandemic emergency benefits, PUA, which is the for gig workers, as well as regular state and local claims.
So let me ask you a question on your comment. So
Mhm.
when do you expect the economy to hit that 4.5% unemployment rate
By Q4
of 2021? And
Right.
then what do you anticipate, although that would be the state unemployment rate, what would be the full unemployment rate with the
Right,
people
the
that stopped?
U6 rate, yeah, it's going to be probably a couple of percentage points higher when you take the marginally attached and the underemployed. But that even still, I think it's just incredible when you do the math on how much money is being pumped in, and even with an elevated savings rate, you're still going to get a whole lot of activity. If again, timing is going to be key here. Some stuff could be pushed into 2022, and we'll see what the next stimulus package brings. It's not going to be 1.9 trillion. I can promise you that. It's probably going to be closer to 1 trillion. But let's see what the details come in at. But I think the main message, though, is that relative to the 08-09 experience, where you had an 800 billion stimulus plan, you had a banking system that was undercapitalized, and you had a slew of regulatory changes to contend with that probably slowed down the recovery. You have the exact opposite this time around. You have a banking system that's well capitalized, that has weathered the storm fairly well. You have an all-star team at Treasury and Fed right now with max stimulus, and you have that globally too. You have global rates, and you also have a Fed that's committed to a new operating policy at this point, with an average inflation targeting strategy, which is a little bit different than before. So they're going to be lower, they're going to be on the zero lower bound for longer into this cycle, because they're basically telling you, we don't care how far the unemployment rate goes below NAIRU. We're not worried about, we want to generate inflation pressure. We want to have an overshoot of inflation. And that's what we're aiming for. And that means lower for longer, way longer, even longer than last time. And so, it's beginning to look like a V-shaped recovery, but there are certainly issues, and we can talk about them.
Yep. Eric, let me ask you what you have to add to that. And I'm also be interested in your comment on the inflationary pressure that Brett just mentioned.
Connecting those two lines of thought. So we are watching carefully, where inflation might be showing up. It's not yet showing up where it hurts the most, which is in wage pressure. But food and energy is starting to show some signs of inflation pressure, but we might expect that because, we shut down the economy globally and we shut down energy consumption by a little over 10% just based on kind of aggregate demand. So the Permian Basin shuts down their rigs and people start looking to find, cheaper prices for their crops because they need to get them off the field. So the inflationary pressures are on the horizon. We see that picking up a little bit in the term premium in the 10-year bond. You could argue that tips are telling us that inflation's coming, but it's not clear yet that there are strong forces behind that because we're still waiting for the vaccines to percolate through the global economy. We're watching very carefully. Of the 6, now 2 have stepped out. So Merck has stepped out and AstraZeneca has stepped out basically because their efficacy is not there. We still have 2 more vaccine makers to come into the global vaccination effort, and that's something that we're watching, I know, very carefully because the expectation that the virus is going to work has lifted spirits, and we saw trading yesterday with Merck stepping out that maybe it takes the spirits off. So the market's kind of twitching on what the virus will do. But generally speaking, I think the long term, back to Brett's point here about that long term view that the Fed has about keeping interest rates lower for longer has some knock-on effects that we're also watching carefully. And that is, over the long term, you should be expecting to earn maybe in the US around 4% over a bond portfolio. And what you're seeing now is on a forward-looking basis that maybe you're going to get even more than that because interest rates are low. And so that equity risk premium is going to create even more excitement about the stock market because you have no place else to go. And the longer that they leave that in place, there's a chance that, I'm not calling for a policy mistake, but the knock-on effects are that the stock market might find itself a little on the top edge just because there is no place else to go. And we're watching what the earnings are going to be. We're seeing actually very strong earnings on small cap, which is supporting the market move here. So from an economic standpoint, there are 3 things: low interest rates, how the vaccine is going to work, and then we maybe bring this up later, but the move in the dollar, which has to reconcile in terms of current account and capital accounts.
And so let me ask you, Eric, with respect to, again, this inflation, is the inflationary pressure being pushed because there was so much pent-up demand because everybody's locked in their house and wasn't spending anything, or is it because the government is printing so much monopoly money that they're creating potentially inflationary pressure?
That's an interesting point there. I think there's a third component to that. When you think supply and demand, my view would be that it's more about the intentional pinch on supply, and that when the demand does come back, it's going to take time for that supply to work its way back into the marketplace again. And I think on the point about creating more money, I think a lot of the money's gone into at least household savings. The government, as we know, and the businesses have been kind of dis-saving. They've been borrowing more at these low interest rates here. So the inflationary pressures could come from the monetary side, but we don't see, any kind of material signs about that pressure yet. I think it's more on the supply side.
And so won't that inflationary pressure, when it comes, force the Fed to push up interest rates?
So I'll yeah, sorry.
Go ahead, jump in there, Brett.
Hopefully that's what they want. Yeah, they would be happy campers if they had to deal with that problem, and they may wait longer than we average back up.
And that's exactly right. The Fed would certainly welcome a sustained trend in core inflation back to 2%. They've missed on their target for the past 10 years, for the better part of the past 10 years. And what you're going to see over the next few months is you're going to see the year-over-year rate of core inflation start to pick up, north of 2%, 2.3 in 2.6 in CPI, 2.1 potentially in core PCE. But that's really just off of base effects from the COVID-impacted sectors last year. Now, that will then start to tick back down over the back half of the year. And so the Fed has some difficult messaging with respect to its its QE program, because it says it wants to see substantial further progress on its growth and inflation goals. It's going to look like you're getting that progress by mid-year, but then you're going to see a drop off again as those base effects fade, and what you're left with is still what's going to happen on a few of the key components that matter for the Fed, and that's housing rents, and that's also healthcare inflation when it comes to the core PCE. And an interesting point on healthcare inflation is this gets back to fiscal policy, because one of the reasons why core PCE inflation has spiked up a bit, has jumped a bit recently, I wouldn't say spiked, but has been pushed up recently, is because part of what they did with the CARES Act is that they suspended a 2% reduction in Medicare reimbursement rates for Medicare providers. What that did was that pushed up healthcare services inflation in the core PCE, which is the Fed's core inflation metric. It's the largest weight within the core PCE. That expires in March. So if the next piece of legislation doesn't extend that sequestration, basically cut to Medicare reimbursement rates, then you're going to see healthcare services inflation fall back down, taking the Fed even further from their goal. And so, but even just to take a step back, broadly speaking, even when you run out the scenarios of like, okay, let's say healthcare inflation continues to be elevated because they extend this Medicare reimbursement sequestration, and let's say rents are 50 to 75 basis points stronger than we expect, you're still going to be maybe a shade above the Fed's target, and that's not something that they're going to push back on at this point. I think it impacts the pace of tapering maybe, or like when they start tapering QE, but I think it doesn't necessarily bring forward liftoff, which we see in Q4 of 2023.
So Brett, let me ask you, so you going backwards a little bit, you're anticipating a fourth quarter GDP growth rate of 6.3 over fourth quarter of 2020. What do you see as the 2021 GDP growth rate?
Right. So on an annual average, overall, that would work out to approximately 5.9%. So it's Q4 over Q4 6.3, 5.9 on an annual average. That compares to minus 3.35 on an annual average for 2020.
Right, Chris, what's your outlook in that regard?
Well, can I go back to Fed policy for a second?
Yes.
So I like to use a history to kind of guide how I see things. And so, the Fed's most recent meeting, they talked about two things. They talked about we want to see inflation 2% or higher, but they also said they wanted to see full employment recover. Okay, that's a really key thing right there. And so they're going to use monetary policy to help the labor market repair itself. So think about that. Think about our unemployment rate. Think about the displacement of technology happening today. Think about the airlines only recovering by business travel by 50%. Think about the overcapacity in the energy industry worldwide. Think about Microsoft shutting all their stores and Nike now moving to do the same thing, right? Think about all the malls shutting down now. They're actually, I just see overcapacity everywhere I look.
And Chris, that's a really good point, because that part of their new operating strategy after they did the review is that it's not just full employment, it's broad-based and inclusive employment.
Sure.
That means let's look at the Black unemployment rate. Let's look at these different unemployment rate metrics relative to the past. And then even more to that point is that in the past, you'd have a balanced Taylor rule when it comes to your interest rate, prescription, so to speak, where you would say your deviation from full employment and your deviation from inflation, and that would factor into your policy rate setting. The Fed is now saying we're going to ignore if if unemployment is below the neighborhood. That has a zero weighting now in a classic Taylor rule kind of policy prescription. And so it's all about the inflation. It's all about the inflation gap, which means basically we will juice this and see how far we can push it in terms of the unemployment rate and how low can we go. And they're not going to be preemptive about that.
Eric,
So
let me let you jump in here. I want to get your outlook on the GDP growth for 2021.
So let me finish what I was saying here for a second. So think about overcapacity everywhere. And then you look at where the economy is growing, right? So if you look at the public cloud, the 5 categories of public cloud, north of anywhere from 11 to 20% compounding growth investment for the next 5 years, which will also continue to reduce labor costs across the big multinationals and intermediate companies. And so I see deflationary labor trends based on digital investment in a very big way. I mean, think about this. Uber came along and displaced the taxi industry, right? Well, you have there's 13 autonomous car companies launching this year, right? You have Zox in Foster City. You have all these companies launching. That's going to really have a big impact on the Uber industry. And you have drones now. The last hurdle of the FAA was approved for drone delivery. That's a really big deal. And think about the deflationary impact on the low end labor infrastructure of our country that's coming our way. And so when I think about Fed policy, I think about 2008. We were on zero interest rates for 6 years. I know it was a financial crisis, but the labor market disruption might be bigger this time. Okay, and we were on zero interest rates for 6 years. 10 years later, we're still below 2.5%. And by 2019, we never make 2.5% Fed funds rate, ever. This time around, I think the Fed's in a productivity trap. I don't see how they're going to get off of what I think we're real negative yields right now. If you really look at big picture items, we're like Europe. And I really don't see their ability to get out of this. They may start tapering in the bonds, but we're on very low interest rate for a long time, is how I see it.
And that's sort of our general view, I think, is that it's a show me story. And we have a pretty low, our inflation forecast says we're not going to get back to the Fed's target, at least on a sustained basis, until really 2023, that even allows them to start the process of lifting off. And then not only that, their policy rule, once they lift off, is not going to be 25 every quarter.
Yeah.
It may not be 25 every 2 quarters. I would say 25 every 3 to 4 quarters is the sort of rate path you're thinking about. Now, the question with longer term rates is the market going to build in more term premium? Are they going to lift nominal yields regardless of the Fed? Up to this point, what we've seen is that the rise in yields has been break-even driven, i.e. real yields are still deeply negative, as you pointed out, which is a very positive risk environment, right? Will that stop? Will that reach a point where, 5-year forward inflation rates, will they reach sort of a point where investors are saying, yeah, I don't really see much inflation beyond this, but I'm going to put more, is it going to be more term premium risk going forward? That would be sort of a negative there. If we start to see real yields start to rise, like the taper tantrum of 2013 was really, it wasn't just that 10-year yields rose 100 basis points within a few months. It was real 10-year yields rose 100 basis points within less than 2 months. And that was the problem for risk assets at the time.
So let me go back to you, Eric. What's your outlook for the GDP growth for this year?
I don't have the numbers in front of me right now, but the numbers that we we were just talking about, from Brett, I think you're consistent with, I'm actually trying to find the exact number here, see if I can find it, and I'll be able to bring it up towards the end of the call here. But
While he's doing that, I think the consensus for 21 is 4.5.
Yeah, and I would note, like, looking at a lot of my peers, Goldman has moved their forecast, based on expectations of fiscal stimulus. But a lot of others are waiting for the exact details before they make a formal adjustment to their forecast. So I'd say, we're ahead of the pack, but it's where everybody's going to go when, hopefully if we get this another $1 trillion stimulus package.
And so I want to turn to the capital markets real quick. From your opinion, what's the state of the capital markets? The Dow Jones is almost at 31,000. And what are we to learn from the current status? Chris, why don't you go and.
Okay, I'll give you a couple of perspectives on this. So I look at, I have my favorite strategist firms, and I follow David Costin at Goldman and JP Morgan's modeling and everything. So I'll just start by saying, were we at an overvaluation at the end of 2020? My view on that was that we ended the year fairly valued. And you think about monetary policy, Fed bond purchase programs, and that really supported a forward multiple of around 22.8. And I based that modeling off of what happened in the dot-com crisis and the financial aid crisis. And so going forward into 2021, I think we have a slight multiple contraction. I think we have the exact numbers here that I looked at, but I think we end the year between 4,000 on the S&P to 4,300. And I've got to point something out. So by the end of year 2021, I'm forecasting off a full year 22. Earnings per share of $196. I'm assuming a 2 to 5% miss on earnings and a multiple contraction to 22.2. And that gets me to my target. David Costin at Goldman has this exact same target, 4,300. He's using the dividend discount
with the S&P,
yes,
right? Which is at 38.50 right now.
3,600.
Okay,
that's the Dow you're looking at. Yeah, 3,600 on Friday. So the Goldman's looking at the dividend discount model, and they're looking at these different Fed models, and they come to the same conclusion. But here's where I think I could be wrong. So 20 out of 25 years, 1 year forward earnings get revised back 2 to 5%. 20 out of 25 years. 5 out of 25 years, they get revised up. And when they get revised up is where we are right now at the economic business cycle recovery. Typically is the point where you see upward revisions. So think about, we beat second quarter earnings. We had a big beat on third quarter earnings. At the macro level, I'm very confident we're going to have a big beat on fourth quarter earnings. So you see, we're actually beating and now going into an upward revision cycle. Well, I'm still assuming we're going to miss. But JP Morgan now, their target's 4,400. And they're assuming we continue to beat earnings. And the multiple stays at 22.8. So that's how they get the 4,400 number. And I do agree that's a possibility. But I just like to be conservative.
And Eric, what's your take on that?
Yeah, I think the walk down effect has been studied. In the U.S., that tends to be the case, although in European countries, we tend to see a walk-up effect. The effect is that you start out optimistic. We're eternally optimistic here in the United States, and a little bit more kind of sanguine in Europe. But those walk-down effects are real. They're kind of predictable in a way. But Chris is right that when we do see kind of in strong recovery, people tend to follow the dotted lines down and kind of miss the speed with which they come back up again. So that's consistent with the idea that we're in an earnings recovery. And actually, when you look at the earnings, we're in earnings seasons now, but when you look at what's happening in small cap, it isn't just a beta trade. There really are better forward-looking earnings estimates and kind of real growth from earnings expected from small cap. And maybe that's because of the dollar, but the rally that we're seeing here is now broadened out from the FANGs and the other tech stocks now into the real economy, into small caps.
And so are you expecting the markets to keep rising?
It's likely we're in a market environment that supports continued equity investment, because where else are you going to get the returns? So a lot of our families are supporting foundations, endowments and foundations they've got spend rates, and certainly on the institutional side, you've got pension benefits that are still owed out there. So if you're trying to hit target returns, I think in an asset liability world, where else are you going to get the returns? We do see more emphasis into the private markets, private equity, in order to get that total return over long horizons. But the low interest rate environment is supporting and the expectation for the stimulus, because that goes back into the real economy, into consumer spending, that'll support equity prices higher.
So is the market growth forecast, is that based, if I heard what you said, it's partly based or substantially based that there's no other alternative, as opposed to real strong confidence in the economy?
I think it's both. I wouldn't significantly weight either one of those views. I think there is optimism that's starting to, and it's part because of the vaccine, and we in California here, we're opening back up again. We're doing better with the metrics, counting ICU beds. People are starting to understand more about what this new administration's policies are. So I think it's going to take a time for that confidence to resurface. But I think we're expecting, and I think because of the science, I'm going to finish with a very important point here. I think we may see a surprise on the upside as it relates to how effective these vaccines are, because they're a different kind of cure, right? It's an mRNA approach, and that's why we're seeing these high efficacy rates. So it could turn the tide sooner than what the market might be expecting. But all of this ebullience is coming from a variety of sources, right? The consumer coming out of the household, vaccines working, stimulus putting money into people's pockets. So it's hard to kind of pick which one's driving it. But right now it seems like vaccine news seems to move the market day in and day out.
Good. Brett, let me turn to you on the health of the U.S. financial system. So in 2020, we saw moratoriums on all kinds of rent payments, and tenants were not necessarily paying their apartment rents, and companies were not paying their lease payments. Is that going to affect the banking, the financial system, or how do you assess the overall health of the U.S. financial system at the moment?
Yeah, so I mean, I think from the banking system perspective, the Fed is not as concerned about these things. The loans have been extended, commercial leases have been extended. The PPP money, you can now use more of that towards rent. So for the small business community that I think was concerned a lot, I think that's it's less of a concern right now. Where I'm more worried about it are the things that I can't see, and that being, as Chris talked about, what do you need a flagship store for with 10, 15, 20,000 square feet? And how much are we going to see commercial real estate, which was already in a bubble before this? The Fed had been harping on commercial real estate valuations for years, even before this was happening. And if anything, it's even more of a bubble now. And so that's where I think that I hesitate to say that we're necessarily, all is good here. Mm-hmm. And it's in the shadow lending markets, the private equity markets, the private lending stuff, the levered loan stuff that maybe falls out of the purview of the Fed's, monitoring, if you will, from a risk perspective, where I think we may, in let's call it 6 to 12 months when the rent moratoriums run out and the restructurings are not there. So like, take my father has 4 restaurants in the Philadelphia area. And during the pandemic, his commercial mortgages, what they gave him forbearance through all the shutdowns. And then they tacked that on to the end of the loan. PPP certainly helped. But when these things start to run out, right, in 6 to 9 months, there may be some issues that pop up. Whether they're going to be, my hesitancy about being too concerned though is that, are they systemic? Is it like subprime from 08, 09, where you had 300 billion of subprime debt in 08, 09, which in the grand scheme of things, you're saying to yourself that isn't that huge if you assumed like 10% losses, but you had 20 times leverage built on top of it. I don't think that's the case this time, but am I 100% confident that there aren't skeletons in closets that are going to cause some issues? No. And so I think, you'll see that, I think, start to crop up Q4, more of a 2020. It's more of a 2022 issue to me.
Yeah, exactly.
Right now, like rather than like, I'm worried about that this year. I'm more worried about that in 2022 and 2023 causing issues when the stimulus wears off, and there isn't another package coming.
Right.
And you start to see, because we pulled some growth out of 2022 based on this latest stimulus package. And so you are setting up for a bit of a cliff here. And if the Fed's tapering at the same time, or the Fed does something that, throws people off, that's where I start to worry a bit more. So I'm not answering your question, unfortunately.
Okay.
Could I add to that?
I want to go to Chris. Chris, let me ask you, following up on Brett's comment, is the work from home trend now, which has been going on for a long time, is that going to drop demand for commercial real estate significantly in major growth areas like Charlotte, Nashville, Salt Lake City, Boise, cities like that?
Well, the answer is yes. I just renewed our lease, and we were advised to go as short as possible, and so they see this in downtown San Jose for sure. I want to add to Brett's comments because they're very insightful, and I think that we're seeing policy now to get us through this pandemic. That's what we're doing right now. But I have something just incredible. I mean, I have this diverse clientele, right? And I do a lot of airline pilots. And one of my pilots is he flies to Shanghai, right? And they do business travel. And he's telling me that when you take off with the jet he flies, they take off with 20,000 gallons of fuel, of kerosene, 20,000 gallons. And that's one way, and then another 20,000 gallons back. Can you imagine when business travel is cut in half permanently, what that does to the energy industry?
Not to mention the airline industry itself, right?
I'm just thinking the ecosystem around the airlines. What happens? I had a client fly from Wisconsin to Los Angeles for $80. That's for sure government subsidized. What happens when all this stops? Delta Airlines had an article in CNBC. Their union supports 12,000 pilots, half of which aren't even flying. They're not going back. I just don't see it. And that's a big concern. United Airlines CEO said that they thought the airline industry would recover maybe in 10 years. So back to what Brett's saying is that we're seeing policies to get us through through the vaccine recovery. But we're faced with serious overcapacity in many industries.
And the overcapacity, so for example, in the airline industry that you're talking about, is that driven more like by now, COVID will be behind us at some point, but people's habits have changed. And now are people using tools more like what we're using right now, Zoom and
referred to
WebEx
as it's referred to as the consumer behavioral loop. The decisions we make on a daily basis and how we live our lives has dramatically changed. I mean, dramatically changed. most of us will not go back to the office full time. Most of us. Commuting traffic is going to change dramatically. The ecosystems for food around our commercial buildings is going to be impacted. All of the restaurants, Jim, around my office are already shut down permanently.
Yeah.
There's no food where I work now, and they're not going to come back, right? So I think the ecosystem has had a massive shift. And the good news is the digital economy is going to boom for years to come. But Jerome Powell's comments in his last, I think it was the last Zoom meeting I watched, basically said we're not going back to the economy of 2017, 18, or 19. And they're very concerned in two areas of the labor market. One, Goldman Sachs announced a big reduction of partners. And their big investment going forward is automation for Goldman. So
let me ask you in that regard then, that kind of comment in my mind would shake the confidence of people and shake the confidence in the markets, but the stock markets are not showing that.
Well,
why not?
I think they are. I mean, if you look at the airlines, they're down big. The energy companies are down pretty big, right? I think that the areas that are going to get hit hard are down pretty big. So, and then you see industries that are really benefiting. There's an article that I provided you on our website, basically said in 2020, companies that rely on digital distribution and contain labor costs outperformed companies that don't have a distribution and contain labor by 37% in 2020. I think the stock market's really reflecting this reality.
So great point. So Eric, based on Chris's comment, what's the outlook in your mind for business investment in 2021 and 2022?
Yeah, so we're a little more optimistic from listening to management calls with the companies that we cover in our active strategies, in that and not to disagree at all with what Chris or Brett is saying here, but we do have too many hotel rooms and too many rental cars and too many airplanes. But those trends towards perhaps a more connected workforce, connected in ways we're not feeling entirely comfortable with right now. But you're smiling, I see it, so I'm comfortable with that. But what we're hearing is that, and Chris touched on this a little bit, is for companies that were already well in place with their investment towards digital delivery of clothing and food, and restaurants can actually be quite profitable because their staff costs are down as long as their restaurant is humming. So what we're finding is that ex travel, companies can be more efficient and more profitable, and the CapEx spend on databases and how to work better with customers also means that we might be closer to our clients than digitally than you might be by walking into a mall. They know more about you, your personal experience over the internet might give you more comfort in dealing with brand names. So I think one of the bigger challenges is, how do you maintain brands, right? So the Nike store is closing, and Apple's under pressure, and how do you kind of get that experience to take you back into a digital purchase, but you've experienced it in live. So the challenge is to maintain brands through this transition. But the headline was, and this is from the head of our equity desk, is the trends were already there.
That's right, they were.
But let me ask you that.
Can I just before we miss this, I want to point out, fourth quarter of 2019, if you take out the digital economy, S&P 500 earnings were already negative. I think that's a really important thing to realize. The digital economy was pulling the U.S. earnings growth already.
So how does that trend jive with what for 20 years people have called the experience economy? And people will pay $5 for a cup of coffee at Starbucks when they go to McDonald's and pay $1 for the same cup of coffee, but they're paying $5 a cup of coffee because it's a kind of a different experience. It's satisfying and that. So if you're going to go all digital or primarily digital, what happens to the consumer's desire for a real meaningful experience in their purchasing?
It doesn't go away. It just becomes more of a niche, right? So, you know, we belong to, what's this, the food delivery service that everyone
DoorDash
uses?
or
DoorDash. We're on a monthly fee now. And so my daughter calls and orders a Starbucks coffee, and they got to do it because we pay a monthly fee. I'm sorry, just crazy.
right, exactly.
Everything's changed. She's doing college out of her bedroom right now. I mean, I'm
So-
telling you, everything's changed.
So that's the, correct me if I'm wrong, but that's what I've, from the last 5 minutes, that's definitely what I've heard, whether one considers it long-term damage or just structural change to the food, the airline, the hospitality industries is here. We're not going back. Go ahead, Brett.
Yeah, I just wanted to touch on a point, like taking that and concept and thinking about it over the next 4 years, especially in relation to the political economy. So what's the market cap of the 10 largest global companies relative to the next 90 is 65%.
It's pretty scary.
That's an all-time high.
Yep.
So the market concentration, when you look at online sales as a percentage of core retail sales, it is shot up. If I apply Amazon and Walmart's growth over the next 10 years, matching the last 10 years, they will own about half of core retail control, which is retail sales, X housing, home builders, gas stations, and autos.
Yep.
At some point, regulators are going to step in.
And right now,
you have a new administration that is going to be focused on that. You mentioned DoorDash. DoorDash employees are trying to unionize.
and Amazon and Google.
And so I think these are the other structural factors we need to think about in terms of at what point does it become scary big?
And so
Right.
from what you're saying, Brett, is it fair to say that sort of brick and mortar retail is dead or on its deathbed?
No, I don't want to say it's dead. There's always going to be a demand for it to some degree. What I'm more getting at is at some point is the government going to look and say, okay, should Amazon Web Services be spun out of its retail component?
They're gonna look at systemic risk. Yep.
Is there starting to be a lot? The more concentrated you have these industries, the more systemic risk you have. You're by definition, you're increasing the systemic risk around that. And so I mean, these are questions that are like 2-3 years now. Obviously, we're trying to get through the pandemic, and Amazon's needed to get us through the pandemic and
There's a reason they got big. That's right.
Yeah, exactly. So I think again, I'm just thinking like 5 years from now, what sort of political environment are going to be in, and what's going to be the willingness to tolerate this enormous concentration of capital, an enormous concentration of wealth.
And I just want to add to Brett's comments that I think the short-term impact is going to be that if you want to survive, you have to invest in a digital strategy. You're not going to make it. You're going to lose volume advantage and pricing advantage if you don't go digital. And that's, where I was Gartner, if you look at their forecast or Bloomberg's forecast over the next 5 years in the public cloud, investment growth is just going through the roof. There's going to be massive investment. Okay.
But for your typical business owner, that's a different business because the logistics are different. The fulfillment is all different than from your normal retail or whatever model you'd previously used.
They'll have to partner with somebody like Amazon. If you're a small business downtown San Carlos, where I live, you can partner with Amazon. You can have an Amazon distribution, and you're going to need that for drone delivery because the only thing these small businesses have, in my opinion, is they're local and they're convenient. I can run down and get something if I need it. But soon a drone will be delivering it to me, right? And so they're going to need a digital partner. And that's where I see potentially Google, Amazon, DoorDash, all these companies offering partnerships with small businesses, a lot like Amazon has already been doing.
And we see that in China, where you can order something online and get it delivered that day.
Yes.
Which is quite interesting. But let me shift to another interesting area, which I think is flying under the radar, and that's manufacturing. Brett, what do you see happening in the manufacturing sector at the moment?
Manufacturing has been great. It's been the outperformer, so to speak. Because of the nature of being able to, like you said, they've been on the path to automation and robotics for decades now. It's the high contact services that were the epicenter of this slowdown. But manufacturing, the recovery has been certainly a V shape up into this point, looking at any number of metrics. Chicago PMI, manufacturing ISM. So I think that the outlook for manufacturing continues to be bright. I'm curious to see so we have a 2-phase plan by the Biden administration. Phase 1, we already heard about 1.9 trillion. What you're going to get in a few weeks at the first State of the Union address is phase 2 of the Biden plan, which is the infrastructure spending, the infrastructure plan, $1 trillion+ infrastructure plan that is also going to be partnered with tax reform, undoing portions of the Tax Code and Jobs Act, raising of the corporate tax rate, which they're going to do, maybe not back to 28%, but I do have some slides in there. And one of the things that they would like to do is a 10% manufacturing investment, domestic manufacturing investment credit. And so that's another tailwind for domestic manufacturing going forward. And of course, if you have a quote unquote green energy bent to that, that's going to be another important plus. That's even further tax credits. So when you think about, okay, all right, we have the corporate tax rate rising, but if you focus your production domestically and in areas that are a priority for the administration, especially climate change and green energy, you're going to certainly benefit from that in terms of your discounting of your capital cost.
So Brett, let me ask you, especially with the current manufacturing boom, where do you get the skilled manufacturing workforce? Because you're not, just hitting a button, standing on an assembly line anymore, just hitting a button. Manufacturing become much more sophisticated, much more high-skilled jobs. So where are you going to get the people to the labor force to absorb the demand or to meet the demand?
Yeah, for sure. And that comes down to investing in education and your science and technology education. I think that there's going to be, I'm not concerned about a lack of, skilled labor, put it that way. I think that it may take time to get the right set of training, but that's another priority for this administration is, you look at Germany, where they have these apprenticeship programs in which, it's not everybody has to go to college. You can get an apprenticeship with Daimler-Benz or something along those lines. The government subsidizes you for teaching these kids their business, how to make these things. That's something that the administration is looking at. Investments in trade skills, not just pouring money into higher education for, I don't want to talk down on any sort of liberal arts educations, but I think those are the types of investments and policies that this administration seems to be focused on, especially Joe Biden, Amtrak Joe. I think that's the sort of thing that we're going to hear more about in this phase 2 plan, which is going to be rolled out in a month or so.
Let me shift gears and ask you, Eric, with the people being locked down for the last 9 months for the most part and not having places to spend their money other than on Amazon and other digital purchases, what's the anticipated impact of the increase in consumer savings?
That'll drain as people start to spend and feel like they're participating in whatever lifestyle they were imagining over those 9 months or what they were experiencing before that. But yeah, the savings rate is high. But I want to emphasize that when you look at the increase in the household savings rate, it pales in comparison to corporate, state and local governments and what the federal government is doing in terms of borrowing right now at these very low interest rates. And it has some knock-on effects. I'm going to take this just a little bit further, perhaps away from your question, but it has some knock-on effects with the dollar, and then tying that back into manufacturing here. If we're becoming more like Japan, and certainly the Silicon Valley region is subject to non-US components coming into the manufacturing process, the extent that the inflation forces are growing because of a weaker dollar and more expensive foreign goods, then we could see inflation coming from a variety of places. One is that it's just much more expensive to make things here in the U.S. Because the cost of goods going into the process are dollar impacted. But the consumer spending, back to your question, I think was it 12% was the last number I saw in terms of kind of increase in household savings. My professional opinion is you'll probably see over the next couple of years that will likely be halved. I think there's going to be some permanence, just like my grandma and grandpa had after the Depression. They were savers, and I think we're going to have, the longer this lasts, the more the kind of the permanence of having a savings account that can weather an unemployment period. So it's not going to come all the way down to pre-COVID, but it will come down some.
But Chris, let me ask you: won't that money that's sitting on the sideline with consumers, which is actually, in the last 40 years, is not, the savings rates has been low, is that cash going to be pumped right into the economy as people get out and start spending again as the economy opens up?
I don't have a strong opinion on that. I focus more. I do know there's a lot of cash on the sidelines with retail investors in terms of their investment strategy. And I think as we get out of this COVID-19 scenario, the retail investor could start coming back. So I think that helps the capital markets. But I'm not very confident about consumer spending trends.
Okay, let me shift gears on you again, because in the last administration we had the trade deals with Canada, Mexico, China, Japan, South Korea. Are those going to pay dividends in the next year or two, or what's going to be the impact of those, if any?
I think I'm probably the least ready to answer that question in this panel.
Brett, do you have an opinion on
Yeah,
that?
sure, absolutely. It's a question we get. What is going to be the Biden administration's approach to trade? From a very high level, the first thing is definitely a more multilateral approach as opposed to what we saw with the Trump administration, which was very bilateral, right? So where I could see re-engagement potentially with TPP and its offshoot RCEP, I think that would be something that they would be thinking about. But again, this is towards the latter half of this administration. Like, trade is going to take a backseat right now, I think, to other things, obviously. But European,
but not as far as a trade strategy going forward, but as far as the impact of the deals that were done already.
right?
What do you anticipate the impact on economic impact of those is going to be, if any?
I mean, the main things were, USMCA, obviously, which was basically it was NAFTA dressed up with a few TPP, technology things that just kind of bring it up to date to, current situation. So I don't see that much of a difference there. With China, this is where I think it's up in the air right now. One, Biden can't back away from the tariffs immediately. He's saddled with this China phase 1 agreement that was basically dead on arrival because we had this pandemic, right? So there was no chance of ever meeting those targets. So they have to then now revisit and say, okay, how are we going to back our way out of this? So I see a continued détente, but I don't see a rolling back of tariffs anytime soon. Like Biden's going to need to formulate a strategy that allows them to walk this down, but to still can push China in the direction that they want to go, that they want to push China to go towards. And to their credit, I think China has done some significant work on that. And I as much as I cannot stand tariffs, I think they're a terrible policy over the long term. It has forced a few changes in China. We'll see if they last. But for right now, we're not expecting the tariffs to come off this year. And like, you got to remember with that phase one agreement, when you look at the details of this thing, and it's funny because nobody looks at the details of trade agreements, but to meet that manufacturing target, right, where China had to have 30% above its 2016 level of purchases of manufactured goods, U.S. manufactured goods. That was totally predicated on Boeing. Number one, Boeing delivering its 737 Maxes, because deliveries for orders that were already placed to Chinese airlines were included in that stipulation of 30% manufacturing goods. So it's one, deliveries of 737 Maxes. Will China take all of them now? Do they need them?
Right.
Yeah.
And then two, what are they going to buy going forward? And will they be buying at anywhere near the expectation that they had just 12, 16 months ago?
Then Jim, can I just add one thing I did want to add about the China deal? 2019, our firm did a piece on the trade war with China. And what the fallout, it seemed to me, was by the fourth quarter of 2019, it looked to us like we were headed to a shallow recession here in the U.S. There's a number of metrics reflecting that, including the S&P going negative ex digital. But the real impact that happened was we put these tariffs on. China devalues the yuan, okay, to offset this. And then at the macro level in China, factory output expands. And so we had record imports from China in 19, and then we had new record imports from China in 2020. Okay, so the real fallout here happened in Europe. The Europeans, of course, they had a very unfavorable currency change with the yuan. They didn't have tariffs to collect a premium for this problem, and China dumped cheap goods all over Europe, causing they were exporting deflation to Europe. And then you add on to that, Europe was already headed into a recession in 19. And think about Europe's problems, and they don't have a strong digital ecosystem like we do. So we have digital e-commerce that's backfilling a loss in earnings. Europe doesn't have that. And of course, now you see Christina Lagarde talking about how Europe is headed back to a secondary recession. So I think the big trade war, Europe is really the victim, in my opinion, and we're going to get around it. And that's what, so it's pretty interesting fallout. Any comments?
So we've gone a little bit over time, but I want to have one more question, and that's on economic productivity or current economic productivity in the U.S. and what the trend is. Eric, do you have any thoughts on that?
Well, we're seeing a slight tick back up on kind of global productivity, but we're waiting for the next big thing that'll drive productivity improvement. So, capital and wage spend at the enterprise level is in terms of what the enterprise is able to produce is a function of productivity. So the expectation that I would have is that we're learning a lot now about how to work from home and how productivity might increase because of our ability to work effectively from home. BNY Mellon is 45,000 people plus. We're all working from home. And so the idea that productivity might be coming from artificial intelligence, which may have been someone's kind of I think we talked about this last year, kind of where AI might be the next big thing that leads to productivity increases. My personal opinion here is I wouldn't be surprised if our ability to work, those sectors of the economy that can do that, work effectively from home, we'll see increases in productivity.
Mm-hmm. Big ones.
Yeah. Hey, Chris, let me end with one question for you. And that's kind of over the past year, we've seen budget deficits that no one could have ever imagined. And what do you anticipate that these budget deficits and the ones that are coming? So now it's perfectly acceptable to have $1 trillion plus budget deficit, and that's going to continue on to the future. What's the anticipated impact of that on the economy?
Okay, well, again, I draw from history. Think about when we exited World War II. We had similar problems that we have today. And history tells us that they raised the tax rate, the highest tax bracket, the highest tier to around 80% for 4 years, maybe 5 years, right? The US could do something like that. You have to have tax reform. I have no doubt taxes are good. The way I see this, Jim, is we're going to have a big change in the labor market, productivity problems, all these things are going to shift. What's going to happen is policymakers are going to be forced to come up with solutions. So the US goes more socialistic over time, like Europe. We have to have programs for people, retraining, large unemployment rate, right? And so as we add social programs to help people, we have to change the tax code to pay for it, right? Now, in terms of the deficit today, I always keep myself really calm by only looking out 2 years, right? And you have to keep in mind that the US debt seems very high. But then you look at China, and they have a debt to GDP ratio of 240 times. Almost, I think, more than double ours, right, Brett?
Yes, that is correct. And I would also add Japan to that list. So
Huge.
for all those that think that the unsustainable deficits and debt is going to result in inflation and higher interest rates.
Yeah. Italy's way higher than us. India is way higher than us. So you think 2 years we don't have a problem. Long term, I hate to say that there's not a problem, but we're not anywhere near the top countries, and they're managing them with weaker economies.
Yeah, and I want to add to that because it's a really important point. I'm looking at what our modeling is for nominal GDP growth over the next 5 to 10 year outlook. We actually see debt to GDP is going to stabilize and actually go down a bit because we have nominal GDP growth outpacing the accumulation of debt. And so if I see deficits going from, okay, you're going to have you had 13, 14% of GDP deficit last year. That comes down to a little over 10, 11 maybe this year, but then it walks down to -5, -3, -2, and then you have nominal growth outstripping the debt growth, right? And at the same time, you have rates remaining rock bottom, so your interest cost isn't going to rise. And so the CBO's estimates that have those really scary charts of just totally taking off, you have to remember what the CBO is assuming in those estimates. And what they're assuming is nominal growth of about 3 to 3.5%. And they're assuming 10-year rate at 3-4%. And those are just not realistic. You're probably going to have faster nominal growth and you're going to have lower 10-year rate. And so just by looking at these CBO projections, you have to take that as the worst case.
Yeah.
Now, eventually, where it gets to your point about taxes having to rise, you have to address Social Security. There's no question about it. And it's 10 years now. It's not 20 years. It's Social Security Trust Fund goes insolvent 10 years. So that's why the other moving part of this is we are going to see taxes go up. And specifically, they're going to go up on those making 400,000 and above.
Yeah.
And then even more on those making 1 million and above. And that's where it's going to get more progressive and more redistributive in that sense. And, you know, how that transition goes, you know, probably it's probably going to cause a little bit of a wobble, I would think, in some of the risk assets. I mean, if you take away carried interest, I'm trying to think about how it affects things like Blackstone, Apollo, these publicly traded companies. And I don't have an answer yet, to be honest, but it's something that's in the back of my mind right now. Like, once we get through the addressing the pandemic and we crush the virus, then we have to deal with this host of problems that were already in place before that needed to be addressed. And that's where I'm just starting to think about that. Like, and that's why I have a couple slides in there on Biden's tax plan, because it's something to keep in the back of your mind about what's going to come up for 2022 and what people are going to start talking about in 6 months, if not next month, you know.
So Jim, can I just ask a question?
Sure.
So Janet Yellen comes out last week and says, we think there's room to safely raise the corporate tax rate if our trading partners participate. We keep the level playing field. Is she talking about China?
No, so this is the OECD working group on harmonizing corporate tax rates. And it's relates back to the discussion you know, from 2019 of France putting a digitization tax, right? The US had been taking the lead on this, actually, and then Trump administration kind of backed out. So Biden's going to re-engage. He's going to re-engage with the OECD. And what they're basically trying to do is they're just trying to come up with a framework so that you don't have the tax preference, the tax preference sheltering. You have a uniform set of standards, right? So
Is it practical?
So that the lawyers that are setting up these different,
the legalized monopoly and the legalized collusion and acting in concert that you're describing.
Right, to have separate entities selling their IP to themselves and getting a tax break on it. Like, that's what they're trying to close.
Well, that never existed because transfer pricing deals with that. That was an awful example that Yellen used. It was absolutely awful.
Right.
But is it possible?
I think she was, to your point about the original question, she was talking about the OECD framework that they were re-engaging with, essentially.
So will they raise corporate taxes if our trading partners do not cooperate?
That's a good question. And the way I would answer it is this. You have the progressive wing of the party, right? If you're Biden and you're coming into the midterm elections, right? And you know that corporate taxes only make up about 9% of federal revenues. And the progressive wing of the party is screaming for socialist reforms of. You have to do something. And what are you going to do if, like, how are you going to do it? I think the corporate tax raise, and I don't think you're going back to 28, which is what he
just
has.
A little bit of a raise.
It's
to
easier
try to buy some political peace among the
right. If you're trying to balance out the competing interests here going into the midterms of the AOC trying to primary Chuck Schumer, they're going to have to give on something.
Mhm.
And the easiest one to give on is corporate rather than, the more radical measures that these, the left.
Hold on. So unfortunately, guys, we've ran way over time, and I could sit here and talk with you guys about this for probably all day, but unfortunately we're going to get kicked off. So I have to stop us right
Okay.
now. Now that's 10:22 and we're 20 minutes overdue. But I want to thank you guys. This was a great conversation, great information. I really appreciate the time you spent preparing and sitting with us. And I want to thank all our attendees who have been listening and who have stuck with us as we've gone over time. And hopefully we'll see you at more ACG events in the future. Yvonne, do you have any
Everybody.
last moment comment?
Yes, first of all, thank you to everyone. This was, despite the fact that we're over a little bit, this was super interesting. And I know that our audience got a lot out of this, and I wish we could do part 2 in a few months. Maybe we keep that in mind. So thank you to all the panelists. And I just wanted to take this opportunity once again to thank Jim for all the years that he has dedicated to running the C Circle. We are definitely going to miss him a lot, and his expertise, and I hope he won't be a stranger to our ACGSV community. We're still going to pull him in. But I also wanted to take this quick opportunity to introduce you to the person who's going to try to fill his shoes. Kai Westerwelle, Bird and Bird, say a quick hello.
Hello, everybody. That was a quick one. We're over time, and I introduce myself next time when we all meet together. I'm looking forward to working with all of you.
Perfect. Again, thank you to everyone. We'll see you soon. Come join us for some other ACGSV events and enjoy the rest of the day. Thanks so much.
Thanks, everybody.
Thank you, Jim. Thank you, Yvonne.
Thanks,
For having
James.
us.
Thank you for having me.